Want to invest in gold without dealing with bars or coins? Gold ETFs let you do just that. In this video, we'll dive into how gold ETFs work, their benefits, and whether they're a smart choice for your portfolio. Stick around to see how you can get in on the gold game effortlessly. A gold ETF, exchange-traded fund, is a type of investment that tracks the price of gold. Instead of owning physical gold, like gold bars, coins, or jewelry, you buy shares of the ETF, and the price of those shares moves in line with the price of gold. There are two main types of gold ETFs. 1. Physical gold ETFs. These funds actually hold gold in secure vaults. When you buy shares, you own a fraction of the gold stored in the vault. The value of the ETF reflects the price of gold. 2. Gold mining or futures ETFs. These don't hold physical gold. Instead, they invest in gold mining companies or gold futures contracts. The value depends on both gold prices and the performance of mining companies or future contracts. Regardless of the type, gold ETFs let you invest in gold without physically owning it, making them a simple way to get exposure to gold's price movements. Number 1. Easy to buy and sell. Gold ETFs are listed on stock exchanges, just like regular stocks. You can buy or sell them anytime during market hours. If you already have a brokerage account, you can easily invest in gold ETFs, and there's no need to find a buyer or seller. It's quick and straightforward. Number 2. No need to store physical gold. Owning physical gold means you must find a safe place to store it, like a vault. If you don't store it securely, it can get stolen or damaged. But with gold ETFs, you don't have to worry about storing the gold. The fund does this for you. Number 3. Affordable and flexible. You don't need a lot of money to invest in gold ETFs. You can buy as little as one share, making it affordable even for small investors. Plus, since you own shares, you can invest as much or as little as you want, depending on your budget. Number 4. Diversification for your portfolio. Gold is often called a safe haven investment. This means that when other markets or investments aren't doing well, gold can hold its value or even rise. By adding gold ETFs to your portfolio, you can balance out the risks of other investments, especially during times of economic uncertainty or inflation. Number 5. No hassle of physical ownership. When you own physical gold, you have to store, insure, and protect it from theft or damage. Gold ETFs remove all these problems. You don't need to worry about how to keep your gold safe, and you don't need to deal with the hassles of managing physical gold. Number 6. Liquidity. Gold ETFs are highly liquid, meaning you can quickly convert them into cash. You can sell them anytime the market is open and get cash for your shares. In contrast, selling physical gold can take more time and might involve extra costs, such as shipping or finding a buyer. Number 7. Lower fees than physical gold. While there are management fees associated with gold ETFs, they are usually much lower than the costs of owning and storing physical gold. If you were to buy physical gold, you'd have to pay for things like vault storage and insurance. With a gold ETF, the management fees are usually a lot less expensive, making it more affordable. Number 8. Transparency. Gold ETFs are publicly traded and regulated. This means the fund manager has to disclose information about the ETF's holdings, performance, and fees. This level of transparency helps you make more informed investment decisions. With physical gold, you don't always know what you're getting, especially if you're buying from private sellers. Number 1. Price fluctuation. Even though gold ETFs track the price of gold, their price can still fluctuate. The price of gold can go up and down based on things like inflation, the economy, or world events. So, even though you're investing in gold, it doesn't mean the price will always increase. There's always a chance that the value of the ETF might go down. Number 2. Management fees. Gold ETFs charge management fees for running the fund. These fees are usually small, but they add up over time. For example, if you hold the ETF for many years, these fees can reduce the overall returns you make from your investment. It's important to check how much the fees are before you invest. Number 3. Tracking error. Gold ETFs aim to mirror the price of gold, but sometimes they don't perfectly track it. This difference is called a tracking error. It can happen because of management fees, changes in how the ETF is run, or the way the fund holds its gold. So, even though the ETF is meant to follow the price of gold, it might not do so exactly. Number 4. No physical gold ownership. With a gold ETF, you don't own physical gold. If you are hoping to own real, tangible gold that you can store for safety or personal reasons, an ETF isn't the same thing. You're investing in a share of the fund, not the physical metal itself. Number 5. Market risk. Gold ETFs are still tied to the financial markets, which means they can be affected by things like stock market crashes or economic downturns. While gold often holds its value better during these times, there's no guarantee that the ETF will perform as expected. In extreme situations, the ETF might not behave the way you want, even if gold prices go up. Number 6. Dependence on the ETF provider. When you invest in a gold ETF, you rely on the fund manager to manage the gold and operate the fund. If the provider runs into financial trouble or mismanages the fund, your investment could be affected. While this is uncommon, it's a risk you need to consider. Number 7. Limited control over the fund. When you invest in a gold ETF, you don't have control over how the fund is managed. For example, you can't choose which mining companies the fund invests in or how it stores its gold. The fund manager makes these decisions, and you're stuck with them. If you don't like the strategy, or if the fund changes its management, you can only sell your shares if you want out. Number 8. Potential tax issues. Gold ETFs might be taxed differently than physical gold, depending on the country you live in. In some places, the gains from gold ETFs may be taxed at a higher rate than physical gold. This can affect your overall returns. It's important to check the tax rules in your country before you decide to invest in gold ETFs. So here is the bottom line. Gold ETFs are a convenient and flexible way to invest in gold without the need to buy and store physical gold. They provide easy access to the gold market, lower fees, and better liquidity than owning physical gold. However, they come with risks like price fluctuations, tracking errors, and management fees. You also don't own the actual gold, and your investment depends on how well the ETF is managed. Before you invest in a gold ETF, make sure to understand these pros and cons so you can make the best decision based on your financial goals. That's all for today. Make sure to like this video, subscribe, and share it with your friends. Thanks for watching, and I'll see you in the next video.